Welcome back to another episode of Sky's the Limit Podcast. I'm your host, Mike Doherty, and today we have an awesome guest, Ken G. Ken is the founder and managing member of KRI Partners, which is a real estate private equity and investor education firm. He has more than 26 years of real estate banking, private equity, and real estate investing experience. And throughout Ken's career here, he's been involved in transactions that's actually valued over $2 billion in transactions. And he's been involved in acquisitions, management, financing of various multifamily real estate projects. So Ken brings us a wealth of knowledge and experience. And with that, Ken, welcome. Thank you for being on the show.
Well, thanks for having me.
Yeah. So a lot of our listeners, I know you and I were talking before this, a lot of our listeners are kind of just starting out in real estate investing, and you obviously have a wealth of information. So I'd love to pick your brain about how you got started in investing and kind of where you're at today.
Yeah. So I'll give you my background quick. I grew up in Toledo, Ohio, got my undergrad at the University of Toledo in finance, moved to Cleveland, Ohio, where I spent 5 years as a commercial lender, and pursued a master's degree at a small college called university called Case Western Reserve University. I decided after being a commercial lender for 5 years, I'd had enough. I wanted to be a CPA. That's what I actually went to school for at Case, and then became a CPA. Went to work for Deloitte for 7 years. And so I still hadn't gotten into real estate as of, mid-90s. And it was while I was at Deloitte that I realized, actually what I did, my kids this is like a long time ago, right? Like 27, 28 years ago. My kids were very young. My daughter had just been born, and I used to do her 3 a.m. feeding. And that was cool, right? Because it's my daughter, right? If you have kids, anybody that has kids knows, man, father, daughter, it's like they got you wrapped around their little finger. It was a very cool time until I realized, Ken, it's 3 o'clock in the morning, and this is the best you can do with your daughter. Why? Because I worked so much when I was at Deloitte. It just that profession controlled your life. And I realized, man, this is not cool. I don't want to do this. I don't want to miss my entire family growing up. And so when I was at the bank, all my customers were in real estate, right? I didn't do commercial. I didn't do real estate lending, but I did a lot of commercial lending. I knew they made a ton of money in real estate. Then I went to Deloitte, and that office, the Cleveland office at Deloitte, had a massive real estate tax practice. So I got to see, if I told you who our clients were, you would know them. They're household names. They were making insane amounts of money. And I'm like, man, I need to figure this thing out because these people are figuring it out and they're making a lot of money. And I'm pretty sure they got to control their own life. So it was when I was at Deloitte that I said, okay, I got to figure this out. I don't want my family to grow up without me. So I started going to apartment association meetings and networking with the person that spoke that day, just trying to figure it out, right? None of the stuff that we have today existed back then. None of it. So it was very hard, very painful to get to learn. But I finally got up the courage to buy one 28-unit apartment building in a place in Cleveland called Shaker Square. It's in Cleveland and kind of in Shaker Heights. Bought a second building, a 24-unit, then a third building, 22 units, sold them 3 years later, made $500,000, and then realized, holy Toledo, what just happened to me, right? Because having $500,000 in my bank account all at one time was just ridiculous. It's not even believable. And then I had done it. So I stuck around Deloitte for another year and a half just because I'm chicken and I'm scared and I want to make sure I do the right thing. And this all I've done since. We've done a couple $100 million in deals just in real estate, billions in the private equity space and everything else. So now this is all I do.
Wow, that's amazing. Congrats on all your success. So I'd like to kind of unpack that first deal. You had a lot of accounting experience and finance experience, but most people, when they buy their first deal, it isn't a would you say 28 unit?
Yeah, it was 28.
Most people won't go out and buy a 28 unit. So what led you, they'll buy a 2 to 4 unit, use Fannie Freddie financing, maybe an FHA loan, live in one unit, kind of rent out the rest. So what made your first deal ever go right to a 28 unit?
Yeah, that's a really good question. So think about, I'm at Deloitte, I'm working 80 hours a week, I'm a CPA, I have a very young family. I had a thought of 1 to 4 family. First of all, I couldn't figure out how to value it. Like, I don't understand. How do I know how much it's worth? How does that equate to how much money I'm going to make? I got really scared of the 1 to 4s because I thought, okay, What if I eke out $100 or $150 a month on these things, and then I got to replace a roof? Like, there goes all my profit, right? I had all this profit for years, and all of a sudden, boom, boom, the roof just take it all away, right? I get scared, and I said, all right, that doesn't make sense. So what I needed to do was to buy something that I felt like I could run like a business, something that had enough income that I could hire somebody to go do work at the property, that I could hire somebody to show the apartments and to do that, because there's no way I had time in my life to do it. That's what took me to the 28 unit. I thought, oh, this kind of makes sense. I can kind of run this like a business. And that's what I did. I mean, I still had not left Deloitte when I sold those buildings. So that means, I mean, imagine you don't know what it's like to be in a public accounting firm, but there are rows of cubes,
Oh
cubes
yeah.
after cubes after cubes, man. It's like they called it the bullpen, and it
Right.
is. It's the bullpen. And so I would, be talking to my manager really quiet in the cube so nobody could hear me. But she did just about everything for me on site, which allowed me to run those properties. So I needed
Wow.
a business. That's why I did it.
Yeah. No, it makes sense. If you don't mind me asking, what the numbers looked like on that 28 unit. I don't know the Ohio market. I'm based here in Connecticut. Know a little,
Hmm.
I know the New England market pretty well, but um, when I think of a 28 unit here, I'm thinking it's probably at least 2.8 million, about 100K per door. What are the numbers like? What are
Not
the
back then.
numbers look? Not yeah, not back then. So
Not
what did
back
the
then.
numbers
No
look like?
way.
And what was was it a value add deal where you were able to, increase rents or increase or through construction,
Yeah.
and then you had an exit plan to sell it, or did you just the market
Oh, you act
appreciated?
like I had this all planned out.
What
Yeah.
transpired for the sale? Like what?
Yeah. All right. So let's unpack what you just said, because
Yeah.
there's a lot there. So are you ready for this? I paid 500. You're going to remember every deal. I paid $575,000 for my first deal.
For
It was
28
28 units.
units. Oh my
It was a little over
gosh.
20,000 a unit. This is
Sheesh.
Cleveland, okay?
Was it a war
28
zone?
years ago. What?
Was it a war zone, or was it like a decent area
It
to
was a C. It
invest?
was a C area.
Yeah, okay. All
It was
right.
probably
Yep.
a little worse than I realized at the time,
Sure.
but it
Yep.
worked. It worked. So my second deal, I think it was 640. That was a 24 unit, and my third deal was 22, and I paid the most for that. I paid 715,000.
Wow.
Right. So
Wow.
all right. So so you went you act like I planned this all out. So when I bought that first property, I'm like, man, I hope I'm doing the right thing, right? You said I had this financial background. Yeah, I did, but that doesn't mean I know anything about real estate. I didn't.
Right.
And so I hired this attorney, paid him $3,000. Like back then, that was a lot of money. And I said, look, you do the legal work, but he also owned 4,000 units.
Oh
So
wow.
he gave me that validation to say, oh, yeah, I know the property. I know the area. I know the owner. You got a great seller. He's like, I think in 3 or 5 years, you'll make 100 grand. I'm like, whoa, seriously? I mean, that gave me a lot of confidence. So we bought it. Now, there's a story here. So I bought it. I closed on it. My little lady that worked part time at the property, I gave her a free unit. She would send me the rental applications because remember, I was a lender. So I knew about credit and all that stuff. I'd run the credit report and terrible credit, horrible. Now, my rents were 415 a month, right? I mean, think about it, that's crazy low. And that included heat. So I'm
Wow.
like, man, what am I going to do? This sucks. No, I can't get any good people to live here. Then I started realizing maybe the neighborhood struggled a little bit. Then I met this wonderful lady. Her name was Karen. And I said, Karen, I don't know what to do. She was with the Shaker Heights Housing Agency or something. She goes, well, let me meet you at the property. I did. She met me. She's like, Ken, this thing was built in 1938. Your kitchen is from 1938. Nobody wants to live in an apartment with a 1938 kitchen. If you've ever seen one, they are not pretty. Okay, metal cabinet. It was horrible. She's like, no, man, you gotta fix it up, and everything will be cool. I said, well, how much? She goes, you'll probably spend 5 grand a unit. I'm like, Karen, I just borrowed my down payment. I don't have any money. Like, what? Are you crazy? She's like,
Hmm.
look, all I'm telling you is if you build it, they will come. I said, all right. So I borrowed 5 grand, did the unit. So my rents were 415. After we did the unit, all we did was sand the floors and replace the kitchen. We rented that apartment at 599.
Perfect.
That's how I figured out value add. There's a reason I told you that story.
Yep.
I would like to tell you that I had this. I was cool. I knew what value add meant. I knew how I was going to add value. None of that was true. I mean, I
Yep.
literally got lucky. And
Yeah.
when
No.
then she taught me value add, and that's how we ended up making money in this business. First application that came in was a Case Western Reserve grad student. My parents co-signed. Oh my gosh, this is perfect. I learned a lesson
Wow.
there. If you ask too little for your rent, you'll get the wrong renters. If you ask the right amount, you'll get the right person.
That's right.
So many lessons to be learned on that first deal.
Yeah. Wow. And then basically number 2 and 3 were kind of just rinse and repeat strategies of
Well,
that.
so number 2, I said, okay, how can I do this? And I learned that the lender would help you. So I'm like, well, what's that mean? So if I bought the property, they financed the property acquisition, and they said, if you get the rents to whatever you thought they should be, you had a signed lease and they would come and inspect to make sure the person was really living there, they would pay me X amount for every renovation I did because now the property was worth more. I'm like, oh my gosh. So they would give me like 20 grand for each renovation that I spent like 4 or 5 on. I was like, this is
The
crazy.
lender would?
Yeah, because they're lending based on the increase in value, not how much I spent. Remember, this is 25 plus years ago.
Right,
The
right,
world
right.
was very different than it is today.
Wow.
So you can see how what happens is I take each lesson and I'm applying it and I get better at it. So 27 years later, I mean, we're doing that even today, and obviously we're in a different position than we were back then.
Wow. 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 That's amazing. I've never heard of a lender paying you to renovate your units. But it makes sense to
Oh
increase the
yeah,
value, but there's got to be an exit strategy in it for them. But no,
yeah, they're
that's wild.
lending more money, and
Yeah.
then they have value to support the new loan amount. Yeah, I mean, bridge lenders do it all the time.
Yeah. Hard money lenders. Yeah, I suppose. But I
Well,
would,
no, not even hard money. It's not just hard money. Bridge lenders today, I mean, you can go, debt funds offer bridge loans all the time, and they'll help you with that.
right. Yeah. No, I see what you're saying. So fast forward to your portfolio today. What's it look like?
Yeah, today we've got probably just under 1,000 units. So we've done now. We're closing deal number 20. We have taken 14 of our deals, what's called full cycle. So we bought it, we ran it, we sold it, and we made money. And probably we've been doing this with other people's money, syndicating, and now we run funds probably since 2004, 2005. So it
Amazing.
looks
Yeah.
very different than it did in the beginning, that's for sure.
Yeah, I know there's a lot of scrutiny with actually before I was full time in real estate, I used to sell mutual funds. So I know there's a lot of SEC and scrutiny with having a fund versus doing a joint venture or
Sure.
just a completely private deal. And I know I always forget the numbers. It's like a 503B and C.
506B or
Yeah,
C.
there it
We
is.
do C's. Yeah,
BDCs.
506C. Yep.
Yeah, so you're a registered fund.
Yeah. I
Yeah.
mean, so what you do is with the SEC, you have to file all this paperwork unless you meet an exemption. Then you just file a form. So we fall under the 506C exemption. So we still have to pay them some money and file a form, but we don't have to do the full IPO thing.
I got you.
So
Okay.
that's
Are
kind of
you
how it works.
now with that? Are you able to raise capital from anyone, or is it
Yeah.
just accredited investors?
Well, yeah. So they have to be accredited.
They got to be
Yeah.
accredited, and
Yep.
then, but it doesn't have to be friends and family, right?
Correct. Yeah.
Okay.
So the way it works, the 506B is the one that you're allowed to have up to 35 non-accredited investors, but they
Right.
have to
Yep.
be sophisticated, and you can
Hmm.
have unlimited number of accredited investors. But here's the catch: you have to have a pre-existing relationship with them,
Exactly. So that's
right?
a 506B.
B as
Got it.
in
Yep.
boy. Yep.
Yep.
But now they say, okay. I mean, you could see I'm here on this podcast, right? I'm talking about our funds. Well, that's marketing, that's
Sure.
advertising, that's
Yeah.
soliciting.
Yep.
So I can't do a 506B, right? For you and I, if we just met today.
Right.
So we do the 506C. So the SEC says you can go ahead and market, but in return, you can only allow accredited investors into your fund, and you have to verify that they're accredited. You can't just,
Right.
I swear, raise your
Right.
right
Right. Right.
hand kind of thing. You have to prove.
And for the listeners out there, what constitutes an accredited investor?
Yeah, if your net worth without your home is $1 million,
Hmm.
or you have income for the last 2 years equal to $200,000 or 300 if you're married with your spouse.
Combined, right? Okay.
One of the two. You have to meet one of those two tests.
Okay. Fair enough. Yeah, awesome. So you're raising capital for the fund, and then the
Mhm.
fund will go out and invest in multifamily assets. Are you still
That's right.
just doing multifamily?
Yeah.
Okay. And are you still just doing it in Ohio, or have you spread out throughout the country?
Oh yeah, we don't do anything in Ohio anymore. We haven't done anything in Ohio in 10 years.
Okay.
Where most everything we have is in Florida, and we're currently focusing in addition on Texas and the Carolinas. But
Okay.
everything we have right now at this moment is in Florida.
Okay. Whereabouts in Florida?
All over Tallahassee, Winter Haven, Tampa, St. Pete,
Okay.
Bradenton,
Yep.
Daytona, all over the place.
And so, one of the, I speak to a lot of different people, and a lot of people are doing, they're raising capital. Their investors are getting double digit returns. But in
Mhm.
order to meet those double digit returns, ultimately there has to be, this is kind of my gripe with, raising capital and meeting these return expectations is because you eventually have, in my opinion, unless you find a truly great value add deal where you can do a cash out refinance, keep the property yourself and pay back your investors and meet those returns, you ultimately, correct me if I'm wrong, you have to sell. You have to have a 3 to 5 year exit plan, unless I guess it appreciates to a point where you can still meet those returns. But I think with a fund, it's probably different because if I'm investing in a fund, then I'm not just investing in any one particular deal where you have to meet that return. It's just kind of the returns as an aggregate overall, right?
Yeah, so we generally have a couple of assets in each fund. We
Okay.
just keep rolling our funds. This is what we do. It's easier that way. We do what's called closed funds. So, for example, we just closed fund number 4 to new investors. We're opening our next fund so that people that come to us tomorrow have a place to go, and nobody new is allowed in fund number 4. Right. So that's
Mm,
what it means to be a closed fund. And fund 4 will be fully invested in 2 deals.
wow. Okay. And
So we just roll that forward. But your point's well taken. I mean, the properties that we invest in should make money. I mean, that's the whole goal. And the reality of it is the best of every world is if you can add value, improve the value of the property, refinance, give your investors back their money. They're still in the deal. Then they
mhm,
go and invest again, right? If you can keep
right.
that cycle going, I mean, that's how you create massive wealth because
Sure.
you're recycling that same capital. So you can sell. I mean, we'll sell older stuff, right? I don't want to get like the 30s product that I started with. I don't want to
Yeah.
hold that for 20 years. No, 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 no. We don't
Right.
want to do
Right.
that. But the newer stuff, like we're closing on a 2023 build. Last year we bought a 2023 build. I'm happy to hold those for a while. It's my goal
Yeah.
to get everybody their money back. And they got who doesn't want to own an apartment building for free?
Sure. And what kind of returns are these things spitting off roughly?
Yeah, so it depends on the deal. Our target is mid-teens annual rate of return, and
Yep.
and part of that is a 5 to 6% cash on cash.
Wow. Yeah. No,
That's our
that's
goal.
amazing. Way better than up here. I'm primarily investing in multifamily and in commercial assets. But I always feel like, to your point earlier, a roof comes up or you need to redo the driveway or some of the bigger capital, CapEx things. It kind of makes you wonder what else is out there. And I've been looking into like triple net lease, something that's going to, a cap
Mm,
rate of 7-8%, where, I can manage it myself because I'm not dealing with any of the kind of inside the
yeah,
walls. I got to deal with a roof, a parking lot, maybe some exterior siding.
yeah,
But other than that, the tenant's dealing with everything and I'm still making 7 to 8% return. So when some of the, at least up here in New England, some of the multifamily, will buy at 100K a door, and you're getting 12 to 1400 per unit in rent. So you're doing okay, but
I'd
sometimes
say.
it gets so frustrating. I'm like, everything's got to go to triple net lease. I don't
Well,
know.
what I think I want you to think about this: when you buy these multifamilies, your goal is to increase NOI,
Sure.
right? It's all about rent upside
Yep.
because it's this simple. If I raise your rent $100, how much would that cost me? Probably zero. So that $100 a month falls right to the bottom line, turns into $1,200 a year. And if you cap that out at a 5 cap, that's 24 grand in new value.
Exactly.
Like
And
that,
for all
you
the
just keep that
listeners,
math going.
yep. Yep, exactly. And for all the listeners, what Ken did was he just took the net operating income divided by the going cap rate, and that'll spit you out the value of the deal. And that's how in commercial real estate you value it is you take the
That's right.
NOI, which is the beauty of commercial. And for the purposes of commercial, we're talking about anything that's over 4 units, 4 units multifamily. Obviously, obvious ones are office buildings, self storage, mixed use, large apartment buildings, things of that nature. But that's the beauty of commercial is you can really predict your outcome versus in the residential 1 to 4 units. You're really a holder to an appraiser on the sales comparison approach versus the
That's right.
income approach that the commercial takes. So that's the power of commercial. I deal with a lot of clients that are like commercial resident, commercial or residential, commercial residential, and I explain the differences and how an appraiser is going to look at it because ultimately that is how you're gonna that's your exit strategy, right? Whether you're doing a
That's right.
cash out or you're just selling and either 1031 or whatever. But so you, I assume, based on your first deal, you primarily just do commercial apartment buildings.
Oh yeah,
Yeah,
I've never done a 1 to 4 for investment purpose.
yeah, yep.
I just
Wow.
don't know how to make it work. I can't. I don't know. Some
I
people
mean,
do it very well. Good for them.
yeah. Some people that's all they know, and the one thing I found again for the listeners that if you're going to the larger apartment buildings, one, it's amazing. It's one spot, all under one roof, management wise, maintenance calls wise, it's all in one spot, right? But you better have reserves. My partner and I bought a building here in Connecticut, and we had that same kind of philosophy. Is we were
Yeah.
in the residential game, we wanted to go bigger, so we bought a 40,000 square foot mixed use building, and it had an elevator, has a service
Whoa.
contract with Kone, one of the reputable,
Yeah.
companies, but a closure door, it had to be fixed. It was
Hmm.
$17,000. There's nothing we could do, and we
Yeah.
need it to be operable. So, with big time, purchases come big time expenses, and that was a really good learning lesson.
Oh, I bet. Yeah. You say the word elevator, I think it costs you a couple grand.
Yeah, yep.
It does.
But bigger roofs, bigger sewer lines. It's just you got to have the reserves. Which I mean, talking to you, you obviously know that. So for the listeners, what would you say if you could, go back and do anything different? What would you recommend? Just if someone's just starting out, what would you recommend?
Yeah. So there's something available now, and it's part of the reason the other half of our business exists, and it's the education side.
Mm,
So many, I mean, I told you I didn't even understand value add going in. I mean, just so many things that could have gone very wrong for me in the beginning. You can avoid those now. So if I were to start it all over again, I would, our education program, and I'm not here to push my education. I'm just telling you what we do. We teach somebody that's getting into this business everything that we do and we know.
hmm
Holy, could you imagine if I had all that knowledge back then? The outcomes would have been so much. I mean, they were great to begin with. They would have been insane because I made so many dopey mistakes because I just didn't know. I just had
Right.
no idea. So that's the thing. If you're starting out, whether you come to us or anybody else, you got to learn the business because the reality of this business is you're going to run out of money really fast
Yep.
because it just is so capital intensive. And so that means you're going to have to raise money, but now you're going to ask for someone to give you money. And if you don't really understand the business, you're not going to be feeling good about doing that. And they won't give you the money. If they sense you don't really understand the business you're asking them to fund, they won't give you the money. So that's why I say that, because there's so much available now to learn. So many of the mistakes that I made are easily avoided now.
Yeah, and your education platform, is that like more of a mentorship or more of an ongoing weekly call thing, or is it kind of you created this, call it a big book or Bible, and you buy this and you kind of read through it, you give examples. What kind of
Yeah.
educational platform is it?
Yeah, so it's comprehensive. So the first part, they're video courses, digital. So you'll
Hmm.
watch the videos all you want, but that's not enough. We also have workbooks and all of our spreadsheets that we use in our everything that we use every day for our business, we give to the people in our program. That still isn't enough. Here's the important part. They get me Tuesday and Thursday every week for group coaching and Q&A. Just the underwriting piece of it alone, I can't create a course that's going to fit your situation in Connecticut. So that means that I've got to be available to you to help you bridge that gap between, well, what are you talking about in the course? And this is reality. I'm there to bridge that gap and to answer your questions. When I say it's comprehensive, my kids are grown now, right? I told you I did my daughter's feeding in the middle of the night. I mean, she's grown now, right? Completely grown. My kids are gone. So now I have the opportunity to help other people. I mean, this real estate thing has completely changed my life. I'm not a CPA anymore. We'll never go back. And I want to help people do that same. And I just know that if somebody with 27 years of experience would have helped me in the beginning and literally was with me 2 to 4 hours a week. Wow.
Yeah, you could really scale a lot quicker
and save a lot of money.
Save a lot of money.
Just everything. Yeah, just everything.
Right. One question I always like to ask all of our guests is your daily routine. I'm very much a routine person, and I would love to know from the time you wake up, from the time you go to bed, run me through a day. What does your day-to-day look like?
Yeah, so it's going to depend. I travel a lot because I live in Cleveland, and everything we do is in Florida. So if I'm in Cleveland, it's usually up around 5, do my thing, come to the office. I probably work probably 10 to 12 hours a day. Doesn't feel like work, though, because I get to do things like this that are actually fun. And so it doesn't feel like work. And then I go home and hang out with my wife. And then if I'm traveling, it's different. I'm usually running around at properties or, out talking to investors to raise capital or just meeting people, networking, just like you should do in this business.
Yep.
So that's typical. Vacation wise, we love to cruise. We just came back from a cruise. You can't beat cruising, especially with your family, because everybody gets to do what they want to do.
That's right.
And everybody's happy.
Awesome. Nice. That sounds great. So what's next for you? Just continuing to grow the fund, raise private capital, invest in more deals, and just kind of keep that going?
Yeah, but more importantly, helping other people understand this business.
Okay, more the educational side. Yeah.
We're doing both, okay?
Right.
We're doing both. But, I never really understood how it would make me feel to change your life or someone else's life. But once you see them get their first deal and everything changes for them, everything. And to know that you played a small part in that and helping them get there, because it's hard, right? People they view this as a mountain. It's not even possible to climb. And I'm telling you, it's very possible. You just got to get it done. So that is a very significant part of my life. Now, 5 years ago, I would not have understood that. And I didn't understand that. It was still about me. But now I'm like, no. You can really help these people.
Yeah. It's I always go back to Maslow's hierarchy of needs, where self-fulfilling's up here. So that's awesome that you reached that.
Right.
Congratulations. Well, I don't want to keep you. I know you're a busy man. Ken, thank you so much for coming on the podcast, the show here. I hope all the listeners really enjoyed hearing us talk and hearing your experience. And we'll link, once this is edited, we'll link all the show notes, have your website here, your email, your Instagram, and I'm sure people will hopefully be reaching out to you to learn a little bit more. So thank you so much. I really appreciate your time.
You bet. Thanks for having me. I loved it.
All right. Have a good one. Thank you for watching Sky's the Limit. We're always releasing new real estate content, so if there's something you want to hear, be sure to leave a comment. And don't forget to subscribe to our channel.